There's been a pause where value has kind of retreated a bit as the new variants come, and we'll get into that, and I actually think it's an opportunity. What I say is if you missed that first snapback, I do believe there's a second one coming. I don't think it will be quite as sharp as the first one, but I think there's a second one coming. And one of the reasons why I believe this is if you look at this graph, this is pretty much up to date. You could see, even with that snapback, you have almost, not quite, almost a record discount between value and growth. There was a period of time from around the year 2000 to 2007 when value traded at a hefty premium to growth. So, I mean, there are periods when not only is value not at a discount, but it trades at a premium when you look at that valuation spread. So what gives us confidence that we're not going to have this long, prolonged period like we had from 2010 to 2020, almost 10 years? First of all, one of the drags on the stock market has been the financial sector. And the reason why the financial sector has not performed well is 2 or 3 basic reasons. And when you look at European financials, you could put a little exponent there, because it's even been, I mean, the European financials today trade at about a 40 or 50% discount to US financials. But you had lower for longer interest rates, number one. Number two, you've had a massive buildup in capital on banks' balance sheets, thereby depressing return on equity. Remember, return on equity, the numerator is net income, the denominator is capital or equity. And even if the numerator goes up, which in essence it has, if the denominator is going up faster than the numerator, that will depress the return structure of the business. And as banks went from 3 to 4% Tier 1 capital to 14, 15%, that had a negative impact on the return structure of banks, though one could argue it made them a lot safer. So you've had lower interest rates, which makes it harder. You had a capital build, which makes it harder for growth. And then you had this benign inflationary environment, which was one of the things keeping interest rates down. Well, that's the situation in the rearview mirror, but we know what's happening today. We have inflation pressure. I mean, in the US, we're between 5 and 6% inflation, as opposed to 0 to 1.5%. Now, of course, the question is how much of this is transitory, how much of this is real? I would assert that there's some of both, but with banks at the capital positions at or above where they need to be, you would expect the velocity of money to start picking up, which will aid and add to inflationary pressures. Economic growth this year, they're kind of turning it down, but it's supposed to be around 6% in the United States, other places around the globe even stronger. The biggest problem in the economy today, by the way, doesn't even matter where you go, is what? It's availability of resources. Labor is short. Semiconductors are short. Raw materials are short. There's bottlenecks at ports. Can't get enough truck drivers, et cetera, et cetera, et cetera. So you have all this demand over here, raring to go, people wanting to buy things. Don't forget the savings rate in the US peaked at over 30% during the pandemic, and 85% of the people were doing just fine working, but they can't buy the things they actually want. Instead of getting a big spike recovery, you're getting a recovery like this, and then as things reopen, as supply chains reopen, you'll have more of a prolonged economic recovery. And you can see the impact that the lack of growth had on 2020, and look at it today. So the world is growing again. Again, Thankfully, you don't have a massive reopening. There's not a switch that was flipped that said, the global economy is now open for business. That would really cause problems, I think. And so instead, you have, even within the United States, fits and starts. And I think the good news is that a gradual reopening will sustain the economic recovery. We know not only that his value been lagging, but international value has taken it on the chin. We've had some of these things in our face like a strong dollar, slower growth, but again, these things are reversing themselves. There's no rule that says U.S. stocks always have to outperform stocks outside the U.S. In fact, I think there's a strong argument to make that the tables are starting to turn there. So not only are we very well exposed as value investors, but I think there's acute value opportunity in the international value space. So what's the case? The case is basically there's an investment opportunity based on valuation differentials where there is a catalyst for these differentials to close. The differentials are big. We're going into a period of stronger economic growth. I believe we're going into a period of higher inflation and higher interest rates. And these forces in the backdrop, I think, are extremely conducive to help close that valuation differential.